I'm dreaming about the day where companies would have a report about their human capital investment, right? So human capital would not be considered as a cost. It will be thought of as an investment. Right now, companies buy a warehouse, it's an investment. They invest in people, it's a cost. I don't think that's what we really want. We really want to deepen our understanding about how to invest in human capital, how we make it better.
Hello everyone, I'm Vinay Nair, the founder and CEO of Tiffin. And at Tiffin, we simplify investing success through our platforms, including Magnifi. Our mission to simplify investing success starts with taking the complex, making it simple, and helping you invest with intelligence. Today, we aim to cover a topic that I believe is important, which is the importance of human capital in investing. You've often heard many leaders say people are the most important asset. While that rings true, it's also very anecdotal and not as rigorous as investors would like. This session brings to you a leading researcher on this topic, Dan Ariely. As an academic, I'm thrilled to have Dan join us to talk about this topic, its implications for investing, as well as its implications for folks that run firms as CEOs, founders such as me. Dan is the co-founder of Irrational Capital and a leading behavioral economist, author, professor at the Duke University. For the past 5 years, Dan and his team have researched the connection between deep elements of what is often called as corporate culture and stock price. Dan's groundbreaking work in behavioral finance economics has led to the publication of several New York Times bestsellers, including Predictably Irrational. He has also contributed to several TED Talks with over 10 million downloads and is a regular contributor to the Wall Street Journal's column, Ask Ariely. Welcome, Dan.
I am not sure I can simplify investing. I think actually I'll make it a bit more complex, as you know, rather than simplify. But still, hopefully we can sort out things a little bit.
Terrific, Dan. Let's start with what made you pursue this question. What made you pursue this line of work before we talk about what you found?
So early on in my career, I started thinking about all kinds of ways in which people are irrational. And my definition of this is to think about where we don't live to our potential, where potential is here, but we're here. And of course, it's about how we mismanage our health and how we mismanage our money and hate and the planet. But the moment I got out of a PhD program and started working at the university in this case, but started working at the university, I realized lots of ways in which human capital is going to waste. And I started thinking about all the theories we have about human capital and what was I seeing around me, and things did not fit. And I started doing research. In the beginning, it was very, very simple research. I would bring people to the lab. They would have to do tasks or on the computer or move a sofa or assemble bionicles or do origami, all kinds of things like that. And I paid people. And I observed how things change as a function of my payment and saying a good word and taxing them and so on. Then the second stage, I started working with companies. I would go to Intel or some big companies and I would examine what they were doing, and I would try to change their processes and measure changes in human motivation and performance. And then the third stage is the stage we're talking about now, in which I look not only at a lab and not at one company at a time, but looking broadly across the stock market and look at traded companies and saying, do I have any signals about how companies are treating the employees, how the employees are perceiving the company, what kind of motivation they have, and does that have any prediction about the returns of the company? And I started this quite a while ago. In the beginning, it was a question. Could I find this link? Could I find good enough data to show me that? And the answer ended up being yes. I can find the link and I can find good data and I can prove this connection.
That's great, Dan. As you're well aware, measuring human behavior and motivation within the structure of a company is complicated, and there is nuance to it, to especially, as you said, separate out the signal from the noise. Can you share with our viewers to help them understand the nuance in here and the types of things you looked at to understand this employer-employee dynamic?
So first of all, we have to make an initial separation between what's easy to measure and what's hard to measure. So what's easy to measure? Easy to measure salary, easy to measure a turnover, easy to measure a hierarchical structure in an organization. Those are the easy things to measure. And if you think about them, they almost always connect to what is called extrinsic motivation, the motivation that comes from the outside. And it's basically bundled together with easy to measure, because salary, employee benefit, retirement benefit, health benefits, vacation, and so on, easy to measure, those are extrinsic motivations. And we sadly find that the extrinsic motivation plays a very small role in access returns. And it could be because it doesn't play a big role, or it could be because other people are taking it into account. We don't know. But it turns out that the pot of gold is with intrinsic motivation. And intrinsic motivation is very hard to measure from the outside and not from the inside. Think about something like pain. Pain eventually is a very subjective feeling. I can do something from the outside, but what I really care is how the person feels on the inside. And the same external stimuli can be perceived very, very differently. It turns out that's true about motivation. What you really want to understand is the state of mind. So we have things like surveys and comments on Glassdoor. Think about things like LinkedIn, where you can get an understanding of how people feel. And one of the things that we find, for example, is that absolute salary doesn't make much of a difference, but the perception of fairness of salary is incredibly important. Now, if you ask somebody how fair it is, there's nothing external that can tell you how fair I feel about something. It's my construction of this concept and what information I get. So a lot of the things are about intrinsic motivation. Sense of being appreciated, for example, incredibly important. Relative salary, fairness in promotion, feeling appreciated. By the way, bureaucracy kills motivation. If you think about why, bureaucracy is basically the organization telling the employee, we don't trust you. Yes, you can go to lunch, but we need 16 receipts and video documentation of the whole thing. And we also don't care about your time so much, because we're telling you to go in a certain direction, but we're giving a lot of obstacles on the way. And we don't really care about innovation, because we're making it really difficult to do anything that is not different. So not the same. Anything that is different is going to be hard with bureaucracy. So the things that are really important are this subjective state. Now, I want to say one more comment about COVID. So we have extrinsic motivation, intrinsic motivation. During COVID, the role of intrinsic motivation went up. Why? As a metaphor, think about the kid in 7th grade who goes to school. The teacher can say, put your phone down, don't talk to Johnny, sit straight, read your book. When the kid is home, they can turn the teacher off. So the relative importance of the engine that is running within us changes when we're working from home, because nobody is supervising. And yes, we're adults, we're not exactly like kids, but we're not that different either. If think about going to a meeting and paying full attention to the meeting, or opening your phone and being half on your phone. So I think that the role of human capital is going to only increase even though COVID is over and we're back at work, as long as people are not going to be at work full time and there's going to be some work from home, the human capital is going to increase in its importance. So the things are, it's not extrinsic, it's intrinsic, and it's about people having the motivation to basically do what's good for the company.
That's fascinating. So if I hear you right, Dan, what you're saying is what has historically been easy to measure doesn't matter as much, and what matters hasn't been easy to measure.
That's right.
And your work is creating some sort of an index or an aggregation of all the things that is important, that matters, that is possibly intrinsic. So tell us a little bit about what is the effect of all the things that matter to investing and to stock returns.
Yeah. So think, for example, as feeling appreciated. By the way, I could say here's a good way to make people feel appreciated. Once a month, invite somebody that you work with to have a beer with you. But the reality is that I don't want to give people such simple solutions, because I think that every company and every organization, they have to think about people need to feel appreciated, but there are different ways to get to people feeling appreciated. Different organizations need to do it. You know, we have this tendency in everything to become legal and standardized, and here's the checkbooks, the checklist of feeling appreciated, and the checkbox for feeling that salary is fair, and the checkbox of the low bureaucracy burden, and so on. But the reality is that different companies are different, and I think that they should all care about those elements, but the way to fulfill those needs need to be different. So that's one. So I don't want to give a recipe for appreciation. But if we go a level below, we say we have this intrinsic motivation, and intrinsic motivation have a lot of things in it. Within that, I separate it into two components. The first one we call goodwill. What's goodwill? Think about the gap between the minimum work you have to do to remain employed and the max you could do if you're truly excited. That's a big gap. And that gap, very hard to contract on. This gap is something people move on out of love, not out of a payment. Out of payment, maybe you move a little bit, but not much. So the first thing we need to think about is like what energy there is for people to pull forward. And this is why alignment with the goal of the company, feeling appreciated. People are saying, it's on me now to prove myself. It's on me, it's my task. It's not the company's task, it's my task. So that's the first thing, goodwill. Think of it like an energy going in the direction you're supposed to go. The second thing, the name is not so good. If you have a better name, I would love it. We call it utility embracing. And here's the notion. Imagine a janitor in hospital. That janitor is walking around, they have a job description, but all of a sudden they hear a patient crying. Should they go and check out what's going on and if they can help? Maybe they see a family lost in the corridors. Do we want them to offer help and point them in the right direction? And the answer to both of those is obviously yes. Even though it's not in the job description of the janitor, and they have to do something outside of their job description and then have to work harder to do things. But what we need to understand is people are going in different directions. The trajectory of the company is a combination of all of those, but people's individual job is not always aligned with what's best for the company at every moment. And what we want for people is to basically take on the utility function of the organization. Yes, my job as a university professor is to teach and do research, but there's a new professor here at Duke that maybe I could help them out. Not in my job description and so on, but the best of the university is to do something like that. And by the way, the reason that's so important is that that's where innovation is coming from. People help each other on all kinds of things. People don't just do what's in the job description. They go not just the same direction with more intensity, but they look around saying, hey, I woke up this morning, what's the best way for me to contribute to the organization? Today. So we have extrinsic and intrinsic, and then within intrinsic we have this goodwill, energy and utility embracing, which is looking broader than just our job description and asking ourselves, where could we contribute the most? And those are basically the things that we are trying to measure. And we take almost all the Fortune 1000, and we have a score for each of them. And of course, you could break it into sub-elements of the score, feeling appreciated, fairness in promotion, and so on. But we created one score that gives us a sense of how good the human capital is at that company. And human capital is not something to trade on daily, right? Because if you think about what it means that there's a machine, the company, it runs on human capital. And if people are working better and energized and happier, they produce more. If they don't, they produce less. And of course, it takes time for this energy to come to fruition. New innovation, better procedures, all kinds of improvements. But it's a long-term investment strategy. It's not a short-term investment strategy.
Terrific. And what is the impact of a firm that has better human capital compared to a firm that is probably lower on this measure that you've created? How much does it matter when it comes to returns, if you will?
Yeah, so there's lots of ways to construct, of course, a portfolio. You can think about it in many ways. And just think about two separate things. One approach is to say, by the way, I think that measuring human capital is very much within ESG. It's S, right? And most people don't even know what to do with S. Here is a good part of S. I'm not saying it's all of S, but it's a good part of S. Now, you could take a portfolio that you've created, and you could say, you know what? Here's X companies that I've selected for an ESG, for index, whatever it is, and I want now to add the human capital score to take the top 50% or eliminate the bottom 20%. So you could take an existing portfolio, whatever it is, and then just kind of focus it on the companies who are not just doing what you want them to do as your main mission, but also have a high human capital. Or you can just take human capital separately. But my thought is, JP Morgan did a couple of very nice papers on our data, and in the first paper they show that it's a factor that not only has substantial returns, but it's also a factor that is uncorrelated with other factors. It's not momentum or tech or anything like that. It gives returns, like if you do it in a simple way of comparing it to the S&P, depending on how you do it, it's about 5 to 7% above the index on the historical analysis. But there are better ways to do it. You don't have to just let's take the S&P 500 high and low. You can take actually a serious, a more designed portfolio and try to improve it. And by the way, my mission in all of this, it's kind of nice because everybody wins, right? If we invest in companies who have high human capital, hopefully we make more money. And we invest in companies that do it, hopefully they benefit from the investment. And then the other important thing is to get human capital to be a part of what CFOs care about. And I'm dreaming about the day where companies would have a report about their human capital investment, right? So human capital would not be considered as a cost. It will be thought of as an investment. Right now, companies buy a warehouse, it's an investment. They invest in people, it's a cost. I don't think that's what we really want. We really want to deepen our understanding about how do we invest in human capital, how we make it better.
Absolutely. That's super helpful, Dan. I think, and I'm glad you brought up the context of ESG investing, environmental, social, governance investing. ESG increasingly has become a factor, if you will, in the world of investing, just as there are other factors such as value and momentum. And a lot of different studies have found the importance of that factor in the range of the numbers you're talking about. And you're right that the S in the ESG has been the most difficult to put your arms around.
Yeah.
Now, let's say our viewers want to include this aspect in their investment choices. Let's say they're convinced that human capital factor is important, can be measured. What are the ways they can express this in the markets today without having to do their own research?
Yeah. So right now, there's an index called HAPY, HAPY, that is being carried and managed by Harbor Capital. I think they have either just announced or will soon announce another version of this that takes a slightly different angle, like, because we said you take a pool of stocks and then you decide what to do with the human capital scores. There are a couple of approaches to take. And so I hope that in the next year or so, Harbor will come with a few different ETFs that have different approaches to thinking about human capital. I hope that one will be on gender. There's another really interesting result that we find on what we call management alignment. Imagine two companies. Company A, the employees are not that happy. Maybe on a scale from 0 to 10, there are 3. And the management is at 5. The management is slightly happier than me. That's company A. Company B, the employees are not at 3, they're at 5. They're much happier. But the management are not 2 points above them at 7, they're at 9. Which company is better? The one that is at 3 at 5 or the one that is 5 and 9? If the game was an average game, you would say, oh, the second company is great. The employees are happier and the management is happier. But as we said before, a lot of human nature is about relativity. And the way that the employees are thinking about their satisfaction and so on is relative to what? Whoever is in our area. And it turns out that as the gap between the management and employees go up, overall motivation goes down. Now, all of this, by the way, you run a company. And one of the things that I'm hoping is that people who run companies would take those to heart as well. It's not just about investing outside. It's also about taking a difficult look at the people that we manage and ask the question, are we managing them the right way? Are we sufficiently working on human motivation? Are we helping motivation in the best possible way? And if the answer is no, then let's take some lessons from this very, very large research and then try to implement something in our own organizations.
Absolutely. And so just to reiterate, Harbor has these indices that is based on your work, Dan, is that correct?
Mm-hmm. Yeah.
Great. And this is an ETF that you could buy. In fact, if you go to Magnifi and search for socially responsible investing or ESG investing, you will find this is one of the results that shows up alongside other results. What is your view of lists such as Great Places to Work and investing in, let's say, companies that show up in that Forbes or Fortune or some other publisher list?
Yeah. So first of all, I think that there's a very wonderful self-selection process going on into these things, right? Because self-selection is not always bad, right? It's basically saying some company is saying, hey, I want to be in, I want to measure, I want to improve, and so on. So that's already a good thing. The thing about those lists is that they never validated them on stock market success. There's lots of things to measure about people. For example, we find that health benefits and retirement benefits don't make a big difference. Now, there's a question of what you measure. And those lists are based on some theory about human flourishing. And they basically measure lots of things that they think companies would care about in relation to human flourishing. Not all of them end up being correct, and not all of them are necessarily connected to the stock market returns. So we did a process for many years in which we said, here's a lot of questions that are being entered in an average into this index. Maybe there are many questions here that are not relevant. Let's look at them one at a time and see which ones are good. And maybe also the average is not the right approach. Because here's the thing. Imagine a normal distribution. Let's say it's about being appreciated. You have people in the average, you have people on the upside, you have people on the downside. If you take the average, you weigh everybody in the same way. But it turns out that it's the people who feel particularly appreciated that are pulling the company up. And the people who don't feel particularly appreciated don't do damage. If you think about a normal distribution, you have a question, do you weigh everybody the same? Maybe from a list perspective, you want to measure everybody the same because your goal is to give a representation of your workforce. But if you care about stock market returns, maybe you want to weigh the top people more because that's what's really driving the company forward. So those lists are wonderful, but they were never designed as an investment strategy. Our score draws on some of that information as well, but in a way that has, examined and looked and thought about this corpus of behavior from the perspective of stock market return, which is not just, let's take the average of all kinds of things connected to how people are at work.
Yeah, and that validation is, of course, critical for an investor. Dan, what you said before, I want to just get back to that. As a serial entrepreneur myself, I'm wondering through your work, how much of this culture that you're identifying can be changed? How much of this is something that the company can control intentionally today? And to the extent that they can, what would your top 3 things, suggestion for the top 3 things an organization can do? What would those be for you?
So first of all, I think organizations can do a lot. It's not easy, but they can do a lot. And feeling appreciated, which we've mentioned a few times before, is one of the most important things. And the reality is that we don't do a lot of it. Sometimes I feel that people think that they have like a limited number of compliments they can give throughout their lives. And if these compliments would be over, they would die. No, we have a lot of compliments to give and we should give it more freely. And it's a cultural thing and we just need to get over it. So I think feeling appreciated is one important one. Another very important one is psychological safety. Psychological safety is basically the idea that people can say what they think and they will not be punished. And we live in a world that has more and more of the cancel culture, and it has a lot of negative implications for people's openness and willingness to share. I want that if somebody has an idea that could be very stupid, but has a, let's say, 50% chance of being very stupid and 2% chance being genius, I want them to say it. And if people are afraid of being ridiculed or suspected or something like that, then they're not going to say it. So psychological safety is basically say we want people to feel that there's safety, that you can talk about ideas, you can bring things up, you're not going to be punished. And it's working against some important social waves, but we certainly need to fight it. The third thing, you told me already to pick 3, so I'll pick the third, is I mentioned fairness a few times. Human beings, we are relative creatures. We measure things in relative ways. The amount of light that we have in a room is relative to other things. Lots of things are in a relative scale. happiness, salary, promotions. Creating fairness within an organization is incredibly important. And if we started by thinking about fairness, we could move along. And then, my personal pet peeve is bureaucracy. I think that every organization should examine its bureaucracy very careful, realizing that those are weights. We're putting weights on people, substantial weights, and we should think about how we stop that or reduce those.
Thank you, Dan. I think especially in the current environment, post-COVID or the pandemic era, it's clear that the balance of and I don't like to use the term power, but the relationship between employer and employee has clearly shifted.
Yep.
And as you said earlier, the human capital factor is perhaps going to be even more important. Definitely something that organizations and companies are paying more attention to. And it's only natural that as investors investing in these organizations, I suspect they'll pay more attention to this. So thank you for taking your time and sharing some of your work, your research with our audience. As we mentioned, you can go invest in this by searching for ESG on Magnifi, for searching for aspects around this topic on Magnifi. And hopefully this discussion distills some of the nuance and the complication and the confusion around the topic into a digestible way for both CEOs and for investors. Thank you, Dan. Pleasure to have you on board.
Thank you. Good talking to you as always.
Take care.